Our next lecture will deal with life assurance. In this type of policy, we use the word assurance instead of insurance. This distinction is used to denote an element of certainty. That means we are assuring something that will happen. The only uncertainty would be when the event would happen. The event that we are talking about is death. Life assurance policies are long-term contracts, which means that terms and conditions will be stipulated at a certain date for a number of years in the future. For this reason, an insurer is not allowed to cancel the policy unless, of course, there is something material. On the other hand, the insured, or rather the assured, is allowed to surrender the policy, in which case only a portion of the premium will be returned. The premium in this case is level premium, which means that the same amount of premium is paid every year. The amount payable is called the sum assured. This amount is payable upon death, or in the case of endowment, upon maturity. When underwriting this type of policy, a life assurance underwriter will take into consideration the age, the amount that will be paid at maturity or upon death, the health of the life assured, the occupation and lifestyle, and other factors such as the weight to height ratio. This graph demonstrates that although the risk of death increases with age, in which case the premium should likewise increase, the life assurance policy, however, levels this risk to charge the same amount of premium every year for the duration of the contract. This is called level premium. A typical life assurance policy will insure what is known as the life assured. So, it is only upon the death of the life assured or maturity, depending on the policy taken, will the sum assured become payable. This policy may be in joint names. It is possible for a person to insure the life of another, provided that there is insurable interest. This is typical in the case of a debtor and a creditor, in which case the person has lent money to a borrower will have the right to insure the life of such a borrower up to the amount of the loan. Life assurance is taken out either for financial security and or for investment purposes, since life assurance products can be investment linked. Let us consider three types of life assurance policies: term assurance policies, whole of life assurance policies, and endowment assurance policies. Let us consider the first type, term assurance. This is the cheapest form of life assurance, and it is usually taken out as a security against a loan. Typically, this is taken out when a person borrows money from a bank and in return presents a guarantee in the form of life assurance. This type of arrangement is usually based on a decreasing term, which means that the sum assured decreases during the currency of the policy to reflect the remaining balance of the loan being borrowed. A term policy will only pay if there is debt during the term agreed. Let us take an example. Consider a typical term assurance arrangement, and for the sake of our case, we are considering 25 years as the duration of the term, which means that between the commencement of the policy and the end of the policy, there is a period of 25 years. In this case, if there is debt within the term of the policy, the sum assured becomes payable. If there is no debt during the term, then the policy will expire and the sum assured is not payable. It is only upon debt will the sum assured become payable. Let us consider the second type of assurance arrangement, and this is called whole of life. This is more expensive than term, since the sum assured becomes payable upon death whenever this may be. This typically is arranged when the life assured wishes to ensure that a sum of money will be paid out to the dependents upon his or her death. In fact, this policy can also be investment linked. Let us take an example. Consider a policy having a commencement date, and in this case, the term will not be fixed. Why? Because this policy will pay out the sum assured only upon death, whenever this occurs. So there is no fixed term, there is no amount of years which are stipulated, and the sum assured becomes payable only upon death of the life assured. The third type of life assurance policy that we shall be discussing is called endowment. This is a particular arrangement where the sum assured is also payable either upon death or upon maturity. Again, this is a policy which may be investment linked. Let us take an example. Consider a policy having a commencement date running up to a maturity date. For the sake of our example, we shall be considering 25 years as the term of the policy. This policy will pay if there is debt within the term of the policy or upon the survival of the term. Therefore, if the life assured survives the term of 25 years, the sum assured becomes payable. Therefore, this policy will pay if there is debt during the term of the policy or if the life assured survives the term of the policy, the sum assured also becomes payable upon maturity. There are various types of investments linked to endowment policies or whole of life policies. These could either be reversionary or terminal. These are bonuses, profits added to the investment that is opted for by the policyholder, in addition to the sum assured, which in turn is reflecting the risk of debt.